Let's get straight to it. Today we're talking about a move that's sending shockwaves not just through Ford, but across the entire automotive world. Ford Motor Company just dropped a $19.5 billion bombshell. That's a number so big, it's hard to even wrap your head around. That's more than the GDP of some countries, and it's all about a massive shift in Ford's electric vehicle plans. The company is rethinking its entire approach to the future of transportation. This isn't just a financial move, it's a seismic change in strategy that will shape Ford's future for years, maybe even decades to come. The company is writing down a huge chunk of its EV investments, sending shockwaves through the auto industry and leaving competitors and analysts scrambling to understand what's next. This isn't about accounting tricks. It's about the cars Ford will build, the factories it will run, and the direction it's heading. Every part of the business is being re-examined. The announcement made today has everyone asking, what's happening in Dearborn? Why now? And what does it mean for the future of American cars? A decision of this scale is the result of months of tough discussions and a hard look at the EV market. Ford's leadership has been weighing risks, opportunities, and the realities of consumer demand. It's a major re-evaluation of the all-electric dream that's dominated the industry for years. The vision of a fully electric future is being reconsidered. Instead of a minor course correction, this feels like a dramatic detour, a bold new path that could redefine Ford's identity. The rush to go all-electric is being tempered by a new dose of realism. Ford is acknowledging the challenges and recalibrating its ambitions. For car buyers, this means Ford's future lineup will look very different than expected. New models, new priorities, and perhaps a new balance between electric and traditional vehicles. The legendary Blue Oval is recalibrating its journey, and the whole industry is watching, waiting to see what Ford's next move will be. So, why did Ford make this dramatic move? There are two big reasons behind this major decision, and both have shaken up the entire auto industry. First, the EV gold rush fizzled out much faster than anyone expected. Early adopters were excited, but mainstream buyers hesitated, worried about range, charging, and price. Many people just weren't ready to make the switch, and concerns about charging infrastructure and battery life lingered. Billions were invested, but demand didn't keep up. The result? Showrooms and storage lots started filling up with unsold electric vehicles. Ford found itself with too many EVs and not enough buyers. Second, government policy shifted. Subsidies shrank, emissions rules softened, and the incentives that once fueled the EV boom began to fade away. With less pressure from lawmakers and regulators, the urgency to go all in on EVs eased up significantly. With less regulatory push, Ford could finally step back and rethink its strategy from the ground up. The result? Ford hit the brakes, reassessed, and decided to reset its EV plans, taking a more measured approach. It's not one single factor, but a perfect storm of cooling demand and changing rules that forced Ford's hand. Now Ford can listen to what customers actually want, not just what regulations demand. This means more focus on real-world needs and preferences. This reset is about adapting to reality, not giving up. It's a chance to regroup, innovate, and come back stronger. Ford is choosing a smarter, more flexible path forward, one that can adapt to whatever the future brings. The EV race just got a lot more interesting, and Ford is determined to stay in the game. $19.5 billion isn't just vanishing. It's being carefully allocated, line by line, to address the realities Ford faces today. The biggest chunk, $8.5 billion, covers the cancellation of several planned EV models. Ambitious vehicles that once represented Ford's future, now shelved as the company rethinks its strategy. These were real projects with years of research, design, and engineering behind them. But in a rapidly changing market, Ford decided to scrap them to avoid even bigger losses down the line. Next, $6 billion is set aside for exiting a major battery joint venture with SK On, a partnership that was supposed to power Ford's electric ambitions. With fewer EVs to build, Ford doesn't need as many batteries, so it's paying to unwind the partnership and scale back on battery production commitments. The final $5 billion covers other program-related costs, retooling factories, writing off equipment, and absorbing expenses tied to this major strategic shift, including severance and contract terminations. Each bucket represents a tough but necessary decision to stop pouring money into projects that no longer make sense in today's market. Instead of doubling down on a risky bet, Ford is cutting its losses, freeing up resources, and redirecting its focus toward more promising opportunities. This write-down is about cleaning house, clearing out what's not working, and setting a new course for the company's future. It's painful, and it means facing some hard truths, but it prevents even bigger losses down the road and helps Ford regain control. Ford is making sure every dollar spent now is aimed at a more realistic, sustainable future. One where the company can actually compete and thrive. The message is clear: adapt, evolve, or get left behind in the race for the future of mobility. This is Ford's way of taking control of its destiny, making bold moves now to build a stronger tomorrow. Don't mistake this for Ford abandoning EVs. Industry experts call it a reset, not a retreat. Ford is making a strategic pit stop, adjusting its plan, not quitting the race. The company is still committed to electric vehicles, but it's shifting gears to match real-world demand. Instead of chasing an all-electric future at breakneck speed, Ford is focusing on what customers want now. That means rethinking which EVs to build and when. The goal: develop electric vehicles that are profitable and meet immediate needs. Ford is being tactical, not stubborn, redirecting investments to where they'll have the most impact. This move frees up capital and talent for the next generation of technology. It's a short-term hit for long-term health. Ford's EV division, Model E, is being set up for real, sustainable success. Here's the twist. Despite the massive write-down, Ford's financial outlook is actually improving. By cutting costly, unprofitable EV projects, Ford is boosting its bottom line. The company now expects $7 billion in adjusted earnings for 2025, up from previous forecasts. Free cash flow is also trending higher, giving Ford more flexibility to invest, pay down debt, or reward shareholders. The write-down itself is mostly an accounting move, not a cash drain. Actual cash outflows will be spread over several years, softening the blow. In the short term, Ford's decision to stop spending on risky projects means more money in the bank. This is addition by subtraction, cutting losses to strengthen the core business. Investors are taking notice, and Ford's financial health is looking up. Sometimes the best way forward is to let go of what's not working. Ford's reset isn't just about numbers, it's about the cars you'll see on the road. The company is broadening its focus beyond pure EVs, emphasizing hybrids and profitable models. Hybrids are making a big comeback, offering a practical bridge for customers not ready to go fully electric. Ford plans to expand hybrid options across its most popular vehicles, meeting real-world demand. Gas-powered trucks and SUVs remain a core part of the lineup, especially the best-selling F-Series. Innovation continues, with new gas and hybrid vans for commercial customers. Ford is also developing extended-range electric vehicles, plug-in hybrids with big batteries and backup gas engines. These e-revs offer electric driving for daily commutes, plus the range of a traditional vehicle. A next-gen F-150 Lightning e-rev is already in the works, aiming to be a game-changer for truck buyers. Ford's product roadmap is now about choice, flexibility, and profitability. Making money on EVs has been a huge challenge for Ford and other automakers. But this reset changes the game. By cutting unprofitable models, Ford's EV division is on a faster track to profitability. The new target break even by 2029, years ahead of previous forecasts. This isn't about giving up on EVs, but about building a smarter, more efficient business. Lessons from the first wave of EVs are shaping the next generation. Investors now see a clearer path to returns, boosting confidence in Ford's strategy. Ford is proving it can adapt, cut losses, and focus on winning products. The EV race is now about smart moves, not just big spending. Ford's reset goes beyond cars. It's about redefining the company itself. The big news. Ford is entering the energy storage market, investing $2 billion to convert plants for battery systems. These giant battery packs will power homes and businesses, tapping into a booming market. Analysts predict billions in new revenue if Ford scales up production. It's a smart way to turn excess battery capacity into profit and diversify beyond vehicles. Meanwhile, Ford's Blue Oval City will focus on new pickups, including the next-gen F-150 Lightning E-Rev. The company is blending its truck-building legacy with cutting-edge tech. Ford's future is about more than cars. It's about energy, innovation, and growth. The Blue Oval is evolving for a new era. When the dust settles, Ford's future looks smarter and stronger. This isn't retreat. It's a bold pivot to a more balanced, profitable strategy. Ford is embracing choice gas, hybrid, EV, and E-Rev all under one roof. By 2030, half of Ford's global sales will be electrified vehicles, a huge leap from today. The move into energy storage signals a transformation into a broader tech company. Ford is leveraging its strengths to tap into the clean energy boom. This $19.5 billion write-down marks a turning point, one of strategic clarity, not failure. Ford is steering toward a future where it can thrive, not just survive.